We have our market master of the day, and Nilesh Shah is our market master, managing director and CEO at Envision Capital. Nilesh, great to have you with us here on the program. Thank you very much. And it's good to have you here because we want to talk about IT. It's a space that you've tracked for a long time, and you've strong views about. Nimesh just highlighted what JP Morgan's latest call is. I mean, they downgraded the space some time back. They're coming in again saying that any meaningful rallies should be used to sell. Would you agree with that? And what is your own view on where IT as a pack is at now?
Well, the technology services space is at a very interesting kind of point right now. I probably believe that some of these downgrades are a bit late in the day. There's already been a significant price erosion. A lot of the froth which has been there is clearly gone. So to that extent, I wouldn't be as circumspect about what some of these brokerages are calling out. I probably have a very different point of view that you have two sets of components or players in the IT services space. One are really the big boys, the large guys, the top 3, 4, 5 names. I believe they are likely to be under more pressure because they never had a very, very strong demand environment. At best, probably their revenues grew at about maybe 10 to 12%. And therefore, the impact of margin pressures will be more felt by them. Versus that, some of the tier 2, the mid-cap ones, the specialized players, I believe the demand environment for them, in fact, will get even better. And their ability to hold on to margins will be good because their margins are a tad lower than the large cap names. So I probably think that maybe, yes, if there is rally, you probably switch out from some of these large cap names and you probably get into the tier 2 names. And it's quite possible over the next maybe 2 to 3 years, some of the names from the mid-cap space will emerge to be very, very strong performers.
Oh, absolutely. I think you've hit the nail on the head. Nilesh, good morning. I think for a long time you've had this position that mid-cap IT perhaps is the space. I remember, many years back, Sonata Software was a stock that you had spoken about. It was 20 rupees then. It's now, of course, 700. But just to continue that point, Nilesh, I think the worry is not about just the margin pressure. The worry is on how the valuation got reset post-COVID, and even now after the correction, the point that even JP Morgan is making is that they're still trading at multiples which are 40% higher than the pre-COVID levels and higher than the averages. The question is on multiples. Do they come down even more in this rising interest rate environment?
Yes, that's quite possible, Anuj. I mean, clearly, if global equity markets are going to be under pressure, if the US tech space is going to be under pressure, if indices like the NASDAQ are going to be under pressure, it's quite possible that we would probably see some softening or moderation in the valuations. But when that happens, you've got to be able to differentiate between the ones which will pretty much going to witness growth, which is going to be business as usual, versus those which essentially are going to witness significantly higher growth. And just to talk about valuations, in fact, today there are media reports that there's a global product engineering company called Quest Global, which is likely to basically get sold out. And that is going to get sold out at about 20 times EBITDA to FY23 earnings. 1 year forward earnings, 20 times EBITDA multiples. So there is still a lot of transactions which are happening out there in the private space, which are happening still at probably the current valuations or maybe at premium to the current valuations. So the point essentially is that maybe it's not time to be in the generic IT services companies and be in the specialized mid-cap tier 2 IT services companies. That's where the opportunity is going to be from a multi-year horizon.
Okay, well, just want to point out that today one space that's doing quite well is the auto space yet again. I mean, no surprises there. Eicher Motors is your top gainer. CLSA has, in fact, raised its target price on Eicher Motors to 4154. And they say that the Royal Enfield volumes are growing at a very strong pace. And most of the customers will look to replace their bikes in the next in 7-8 years from when they bought it. So perhaps there'll be replacement coming through. I don't really buy that argument too much because people may want to even replace it with other brands. You never know. But in any case, their point is that demand is picking up. Nilesh, good morning. Your thoughts here, because there's so much brewing in the auto space. Demand is coming back. Supply side issues have been gotten resolved. You think it's too late to get in, or is there more to go?
No, I don't think it is too late. Clearly, the auto space seems to be in a sweet spot, unless, of course, some of the key input prices like steel and all that head even higher than the highs that we've seen earlier this year. So in case if the current raw material environment in terms of pricing and all of that remains pretty much like what it is today, then it's quite possible that the demand environment for automobiles in India remains very, very strong. It has been relatively strong. It's just that they've faced more challenges about supply chain and chip shortages and all of that. And if we're talking about a slowdown globally, especially in a very large market like China, if you're going to see a slowdown, that's going to be advantage India. You're going to see now lesser challenges in terms of chip shortages and supply chain related issues. So on the whole, the automobile space looks extremely exciting, and we're going to see at least maybe a few more quarters of some really strong growth. So I don't think it's too late. And in fact, if there are corrections like we're seeing in the last few days, if you see stock price corrections, that's actually an opportunity to buy into some of the automobile names.
Nilesh, some of the companies that we've been speaking with across a range, I mean, consumer brands and others, not staples. Staples, of course, we've been hearing from them about pressure at the lower end of the price segment. But other companies as well, I mean, for example, Metro Brands that we spoke with and others over the last many days, at the lower end, pretty much everyone is echoing the same thing, that there is stress. Any thoughts on that? Is that likely to spread? I mean, the premium end is doing fantastically well. That's what we hear from most companies we speak with.
Yeah, absolutely. I clearly think the premium end is doing well and probably is likely to kind of keep doing well as they continue to exert pricing strength and are able to basically pass on higher input prices. But yes, the mass segment is facing fair bit of challenges, and I still think that that's probably a space to probably avoid, unless you believe that maybe some of those raw material related pressures have peaked out. So a classic case in point is essentially the food segment, the snacking space. There it looks like is that some of the prices, especially things like palmolive and all of that, are unlikely to sustain at the levels that we've seen earlier this year. And it's quite possible that maybe a few quarters down the line, or maybe a year or two down the line, you're going to see a softening of a lot of those pressures. And in addition to that, bit of margin expansion coming in because of some of the pricing related changes that they have been able to do, grammages related changes and all of that. So that looks to be a relatively safe and an attractive spot within the entire consumer staples. But otherwise, for now, I think one needs to take a few steps back on the entire overall consumer staple space.
The markets, by the way, making a huge comeback, especially in the broader market. The mid-cap index is comfortably in the green. The advanced decline is well in favor of the greens, 3:1 on advanced decline. India Cements is a stock which is doing well. All the auto names doing well. A couple of these second-tier banks doing well. So at least on the broader market, there's a bit of a comeback. On the Nifty, today's low is right at the 20-day moving average, and from that point, the Nifty is already up about 100 points. So maybe that algo trade has played out on the Nifty. But Nilesh. 17,340, Prashant. Nilesh, a word on the market itself, because there's a bit of a debate out here, given what's happening in the US, whether it was just a very sharp bear market rally which almost made everyone believe that a new bull market has started, or actually it was a start of something big. What's your view, given what's happening globally?
In context or in backdrop of the global environment, clearly, yes, in the short term, we are likely to see some pressure. We've had a pretty strong rally over the last couple of months, and so it's quite possible that some of those gains will get shedded. But what we're really seeing is that a lot of stocks, a lot of sectors, especially in the broader market, are actually in a very strong bull market, and that's really where the opportunity is for India and investing into India. And tier 2 banks, the auto component space, the capex plays, and defense. These are some really very interesting opportunities, and I clearly believe that sectors like these are going to be in a very strong uptrend and in a very strong bull market, and which could perhaps defy global trends in terms of softness in global equity markets. So I clearly believe that India is becoming a contrarian play globally, even in context of emerging markets, and within that, some of these sectors are looking incredibly attractive.
Okay, actually, a lot of spaces have come back in a big way. Specialty chemicals was one space that was not doing well for a while. That entire lot has come back, about 15-20% gains is what we're seeing there. Consumption as well, right? Something like a Varun Beverages, Metro Brands, Radico Khaitan, all of these stocks are up and about today. Easy Trip is up almost about 2%. So, Nilesh, what are your thoughts on consumption? The whole consumption space was under a bit of pressure because of raw material pressures, but now raw material prices have also cooled off. Is this a space that you like? And if yes, what bucket are you looking at from a long-term investment standpoint?
Yeah, the general consumer space is quite likely to underperform because some of them will have challenges of both growth and margins and therefore earnings. But two pockets that we like quite a lot in the consumption space is one is essentially the alcoholic beverages space, the liquor companies. We own both Radico Khaitan and United Spirits, and both are well poised. Especially Radico Khaitan, that's currently undergoing a huge expansion plan, which is likely to play out maybe a year or two from now, and they have been making huge strides, especially in tier 2 markets, and building some really solid brands out there. So I think alcoholic beverages as a space looks very attractive. The second space which looks very attractive, which I alluded to earlier, was essentially the foods, the snacking, the biscuits and the bakery space. I think that entire space is looking very attractive. So essentially alcoholic beverages and packaged foods. These are the two sub-segments in the overall consumer space which we like quite a lot from a medium to long-term perspective.
The Nifty is in the green now, 2 points higher, so absolute turnaround from the day's low. Market breadth is comfortably 2.5:1 in favor of advances. So this is a pretty good market that we are looking at. 17,500, by the way, is where the index is at. And so many stocks are now starting to come up and perform. Reddington, for example, is up 7%. India Cements is up 3.5%. Varun Beverages we spoke about. Gland Pharma is up about 3%. There is Astral, which is up 2.5%. GE Shipping is up 3.6%. CRISIL is coming up sharply. Borosil Renewables, which saw some pressure yesterday, is up 4%. And only highlighting things with volumes, Astra Micro is up 5%. It's had a fantastic week month. So, things are looking good. Everest Industries, I think it's a roofing company, 15%, 16% on Everest Industries. So 724 on that one, on decent volumes as well. Nilesh, you mentioned defense. Which segment do you like the most? There we had the management of Mazgaon Dock with us recently. They were talking about some big numbers in terms of tenders which they're going to be applying for. There's Kochi Shipyard, but of course there is the other pack, Bharat Dynamics, BEL, etc.
Yeah, Prashant, defense essentially is one of the most compelling opportunities. Given the geopolitical environment that's really there, especially in Asia and Europe, I think in that context, indigenization clearly is a big imperative. And both the government's resolve as well as the reforms essentially are driving indigenization. And I think in that context, I clearly believe that defense as a space is already in a bull market. It's one of those few sectors where stocks essentially are making new highs. The earnings momentum is strong. Order books are essentially bulging. So overall, I believe that defense as a space will do very well. And, I'm not quite sure if stock picking is going to help too much here, because when the sector is essentially in a bull market or an uptrend, probably everything does go up. Right now, the challenge, of course, is that the private players, the valuations are a tad higher. It's the PSUs where valuations are way more attractive and have a much more stronger kind of an order book. So I probably believe that a basket of both PSU and private players in the defense space look extremely attractive, and clearly believe that that's one area where investors need to be in a slightly more aggressive manner.
All right, Nilesh, we'll leave it there today. Thanks a lot for joining us. Good talking to you as always.